Well, welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I am your host. And for our regular listeners, you will notice that Brian's voice, my voice, sounds a little bit different today than normal. And I actually lost my voice a few days ago. One of the reasons why this podcast is coming out a little bit later than I had hoped. And I was actually really close to not doing one this weekend. I was going to have one of my podcast buddies record an apology episode for me, just a really brief one, letting you know why that I can't post this week. But thanks to some healing and some great warm tea and cough drops, my voice is feeling much better, and hopefully we'll be able to get through today's podcast without any issues. So let's go ahead and jump into it. As I mentioned a few weeks ago, we are launching off into a new series. And I don't have an end point for this series because I'm not sure how long it'll last. And I'm excited about that and have no problem with that personally. Because what we're going to begin doing starting today is working through all of Warren Buffett's letters to shareholders for Berkshire Hathaway. Basically his letters to the shareholders of Berkshire Hathaway going back to 1965 and coming up to present day. And I know that there are some letters to shareholders that Warren Buffett wrote previously to 1965 that are like impossible to find or very difficult to find. If I get my hands on those, we may bring those into the mix. But these are the beginning with Warren's initial acquisition of Berkshire Hathaway. So these are the beginning of the Berkshire Hathaway letters and really the fundamental type stuff that we want to be focusing on. And one of the big ideas behind all of this is really a new direction I'm looking to take with my investing, and I'm hoping you will come with and join me on this journey. As I mentioned a few weeks ago on kind of a preface podcast to this new series, you talked about so far the Invest in the Family podcast as it's looked at different ways during different seasons. And the primary focus throughout all of it has been interview podcasts. Well, I'll bring in some investing experts or people that have a really unique perspective on investing. I'll bring them in and interview them so we can all learn from them. And I love that format, and I have no intention of ditching that. I continue to want interviews to be a big part of Investor in the Family, whether that be our conferences, this podcast, and otherwise. But another thing I've done as well is, spend time going through kind of like weekly updates on important financial, investing, and economic news. And that's something that I enjoy, and I hope to continue to bring into the podcast, because I do think that is a great training piece. As we understand what's going on, we're able to kind of get a vision for the bigger picture, I hope, as long as we're going to quality sources for that, which I hope to always do. All that being said, I don't want to get rid of any of those components. I want to continue to find ways to use those to bring the most value to you and to me. But as I have continued to explore and assess and evaluate myself as an investor, as I talk to each of you as investors, and I hope to talk to all of you a lot more soon, I'm going to do some feedback assessment opportunities for all of you to get a feel for where you are as investors, and so you can have a better idea of how to get basically, quote unquote, from here to there, from where you are to where we want to be. And today I'm going to talk a lot about where I want to be, and I've got a pretty good feeling that I think you're going to want to be there too. So again, back to, as I've been assessing myself as an investor, I realize there are a lot of amazing options, a lot of incredible resources out there. Of course, there are a lot of terrible resources out there as well. Hopefully, we can steer a lot of you clear of those negative ones. That being said, in the investing world, Warren Buffett obviously he's always pointed to as being the great investor, the model investor. He's what everyone wants to be, the path most people want to follow. At least that's the way we describe things. But in reality, I feel like I've talked to a lot of people, and I see very, very few people who are very disciplined in actually following the practices of Warren Buffett and his mentor, Benjamin Graham. And I don't want to be like that. I want to go the extra mile. I want to put in the extra work. I want to put in whatever it takes to become the best possible investor that I could be. And in my study and in my development and my conversations and interviews with others, I realize one of the best possible ways we can view our investing is view it as business owners. So even if we're buying a few shares of Apple out of hundreds of thousands of available shares and no one in the world cares about our influence or lack of influence through those shares, we should view even that small Apple purchase as purchasing Apple. And I pick on Apple. I pick Apple because it's easy to point out because it's so big and most people love it or hate it, I guess. But it's an easy example to point to. But should be true of any company, regardless of how large or small. And that being said, it should be true of any company, whether they are publicly or privately traded. It should be true of any company, even if it's our own company that we started as entrepreneurs. And so when we start developing out that entire spectrum of investment, and including entrepreneurship, including private equity, including public equity, which would be obviously the publicly traded companies that we are most commonly acquainted with through the public markets. And also even bringing in other things like potentially real estate investing, commodities, things along those lines. I don't want to cloud things too much too soon. And I know there are a lot of other great options out there for, especially real estate. For example, the Bigger Pockets podcast. I know Josh and Brandon are great guys and know way more than I probably ever know about real estate. So that's a great resource if you want to learn about real estate, is the Bigger Pockets podcast. You can find them on iTunes or at their website. Not to get too far off track, but just letting you know that's kind of the spectrum. I want to have the mindset that we are business owners. And that's a big deal to me. That shift in mindset is a very, very big deal. And in my opinion, if we don't view our personal investing as a business, then you're poised to fail. And honestly, I feel like you are fundamentally making a really destructive decision regarding your investing, because then it's like, it's a hobby, it's a pastime. And if you are treating your investing as a hobby, then, you're going to seriously regret it, in my opinion. Some of you may be thinking, well, investing is a hobby to me and I'm doing really well. Well, if that's the case, then I'm going to go ahead and make an assumption that it may be a hobby in your mind, but in reality, you're treating it with the seriousness of a business. And that's why you're being successful in that as well. I actually had an interview with one of you the other day. I won't say, well, it wasn't an interview. We talked on the phone offline. I won't say who. That was actually in a scenario where, unfortunately was laid off at, I think maybe 10, 15 years ago. It was one of those things where the department was basically, discontinued. And so it was collateral damage. This person lost their job, but they'd been investing on their own for decades and actually were able to leverage themselves, and their personal DIY investing, their portfolio. So he's actually making more money now off of his portfolio than he did from his income from his full-time job, which is obviously, that's the dream. That's where all of us want to be able to say that, so you're able to basically move into retirement early, because your investments are producing what you need to provide for yourself and your family. But to do that, it requires the seriousness of a mindset of a business owner. And also, I like to use the illustration of a car maintenance. I'm assuming most of us own an automobile. And if you don't, you know enough about automobiles so that this will work as well. If you own a car, there's going to be maintenance and repairs needed throughout the lifetime of your ownership of that car. So basically, you have several options. You can outsource all that maintenance and go to a mechanic or a shop and have them do everything for you. Or you can do it all yourself, or somewhere in between on that spectrum. But wherever you are on that spectrum, the more you understand your car and the mechanics of the engine and all of the automobile, the better you're going to be able to operate wherever you want to be on that spectrum. If you want to outsource all of that work, then you will be able to better pick a great mechanic that you can trust, that knows what he or she is doing, and you can trust what they're going to quote you on prices and charge you and all that kind of stuff. Or on the other end, you can do all of it yourself if you want to, or somewhere in between. But bottom line is, you're equipped to make your own decisions. And with your car, and it's the exact same with your investing. Your investing is a business. You may choose to hire an outside manager to run your business, and that's perfectly okay. But it's not okay if you don't know what you're talking about, because there are too many quote unquote managers, in this case, investment advisors, financial planners, who may be great people and have fine intentions, but being honest, a lot of them very likely do not know that much more about investing yourselves. And the way it works is they will bring you in, and then once you sign with them, they'll pass your money off to someone else that will actually manage it for you. Again, that doesn't have to be bad if you know what you're doing and if they know what they're doing. And if you don't know what you're doing, you won't know if they know what they're doing or not. And so all that being said, I want you and myself to view our investing as business owners, okay? And I'm going to talk a lot about that idea because that identity shift, in my opinion, is crucial for what we're looking to do and what I'm looking to do here as well. So I'm going to come back to that some more in this podcast and hopefully reinforce it. Like today's podcast, and hopefully reinforce that a lot as we move forward. And again, today is going to be much more of an introductory podcast because the book that I'm going through on this. I know you can get a lot of Warren Buffett's letters to shareholders for the Berkshire Hathaway shareholders. You can get a lot of those online from the Berkshire Hathaway website, but not all of them online. So I went ahead and bought a book off Amazon, and I'll put a link out on this that basically compiles from 1965 to 2014. So there's a few that aren't on there, but the few that aren't, I can get online PDFs, which is fine. But I'm working through this book because it's great to have them all printed out. I like having stuff printed out. I can mark it up and make notes and have it right in front of me. But in the beginning of this book, there's some preface and stuff to just kind of give some perspective to why Berkshire Hathaway and Warren Buffett are viewed with the awe or the reverence that they are in the investing space. Because when you look at what has been accomplished by Warren Buffett and his team at Berkshire Hathaway, Charlie Munger and everyone else, it is astounding. And so at the front of the book, again, I'm going to go through just a little bit of background on why following Warren Buffett's a big deal. Because Warren Buffett is a business owner. He may talk about it's best for most people to invest in passive indexes and all that kind of stuff. But you know what? That's not what he does. And I want to do what he does. I want to build my own Berkshire Hathaway. It may never have the size and scope or scale that anyone outside of my family will care about it, but that's fine. But I want to view it with that seriousness. And you know what? Who knows where it could end up? That's my mindset. So again, looking at what I'm looking at an introductory chart here that basically walks through year by year the annual percentage change, basically the annual growth or decline for the market price of Berkshire shares as compared to the S&P 500, including dividends. And so it's fascinating as you work through here, and I'm going to be moving my microphone around a little bit, so if it sounds a little wonky, excuse me. And I can't believe that I just said wonky. I actually never ever used that word. I'm not sure why I did just now. And then I said it twice. So here we go. So I'm just going to jump through a few of these, just kind of give some perspective. And the thing that's kind of crazy is there are a number of years where the S&P did way better than Berkshire Hathaway. For example, 1974, the S&P lost about 26%, but Berkshire lost almost 49%. That's crazy, okay? In 84, the S&P gained 6%, and Berkshire Hathaway lost almost 3%. In 1990, the S&P lost 3%, but the Berkshire lost over 23%. And then in the year, 99, S&P gained 21%, but Berkshire lost almost 20%. And then in 2008, S&P lost 37, Berkshire lost almost 32. In 2011, S&P gained 2 approximately, and Berkshire lost almost 5. I point that out to show that there are years when the methods that we may be utilizing amazing methods, and we may have a theoretically a quote unquote perfect investing plan and portfolio, but there still may be years when the general markets outperform. And on a substantial basis, on a per year basis, and I just listed out maybe 4 or 5 examples where the S&P substantially outperformed Berkshire Hathaway. But that's why we have to view things over time. I can also point to years like 1968 when the S&P gained 11% and Berkshire gained almost 78. I can point out 1976 when the S&P gained over 23%, but the Berkshire gained 129%. I can point out 1979 when the S&P gained 18% and Berkshire gained 102%. I can point out 1983 when the S&P gained 22% and Berkshire gained 69%, or 1985 when the S&P gained 31%, which is fantastic, but Berkshire gained, wait for it, 93%. And I turn the page. Or in 1989, when the S&P gained 31%, which again is amazing, Berkshire gained, drumroll, 84%. And I'm just skipping through a lot of these, looking at some of the big highlights. Or even in 2014, when S&P gained 13%, but Berkshire gained 27%. And again, there's all kinds of intermediate years where they're close or a little above or a little below. But bottom line is, here's the cumulative piece that should blow every one of our minds and should be the convincing aspect of why we want to follow Warren Buffett and Berkshire Hathaway, and not with lip service, not saying, hey, we're value investors like Benjamin Graham and all that kind of stuff, but not do it. I can honestly say of all the people that I've interviewed, I could count on my hand the number of people that I think actually on a disciplined basis do follow in the footsteps of Warren Buffett and especially Benjamin Graham. And in reality, there may actually just be one person who actually do that, in my opinion. It could be a few more, but I can only say one with certainty, and that person is doing fantastic. So let's do this. It's okay. Compounded annual gains from 1965 to 2014. So basically annualized, the S&P has gained from 64 to 2014 with dividends 9.9%. And usually in investing planning circles and financial planning circles, being able to get 10% annual returns is considered like the holy land. That's like the ideal of the ideal. If you can do that, you're doing amazing. And I'm sure a lot of that's based upon the fact that that's kind of over time what you can expect from an index, a market-wide index. But compared to Berkshire Hathaway in that same time period, 65 to 2014, the S&P was 9.9% annualized. Berkshire Hathaway, 21.6% annualized. Okay, already obviously that's more than double. And that sounds amazing, but you think, well, more than double, I mean, that's great, but that doesn't sound like astounding or that kind of stuff. But when you factor that in every year, and the compounding component of that is phenomenal. So the overall gain, and this is where it really starts showing up, for the S&P 500 from 1965 to 2014 was 11,196%. Okay, so the overall gain in the S&P from 65 to 2014, 11,196%. Compared to Berkshire Hathaway, again, drum roll, is 1,826,163%. That's 1,826,163%. That's the difference. Basically, 11,000% with the S&P to 1.8 million% with Berkshire Hathaway. And let me put some more numbers to that to kind of give some perspective. So if you put $100 in the S&P in 1965, it will have been worth basically just a little under $12,800. Okay, so from 65 to 2014, it's about 50 years. $100 in the S&P will have gone from $100 to around $12,800, or a little bit under. I'm approximating. So $12,800. Okay, that's great. Okay, but Berkshire Hathaway, if you would have put $100 in Berkshire Hathaway in 1965, in 2014, after about 50 years, it will have been worth over $1.6 million. So comparing, you will have had around $12,800 with the S&P by doing passive index investing, or over $1.6 million by investing in Berkshire Hathaway. That's the difference, okay? That is why that's why the idea for me of robo-advisors, of just generic, pie chart investing plans based upon your age and risk tolerance and all that kind of stuff. If that's what you want to do and that's what you're comfortable with, then by all means, please do that. And don't let me discourage that. I want you to do what you feel like is best for you and your family. But for me, and I'm going to be basing all this on what I think, and then let you take what I'm doing and thinking, and then you can build out on your own what you think is best for you and your family, as always. But to me, I'm not okay with that personally. And actually, a few weeks ago, I was at a conference here in Dallas. It was a conference, an entrepreneurial conference. I won't get into all the details about it, but one of the speakers there made a comment about how, he's done really well as an entrepreneur, and he's with this financial planner, and this financial plan, and they're trying to talk about different plans and where they can put the money. And the planner they went to was talking about this one bond investment opportunity. And I forget the exact numbers, but basically they said, so if you put $10,000 in this bond fund, in 10 years, you'll have, I don't know, I'm going to say $12,000 or $11,000 or something. It was a very, very, very meager appreciation of value, I'll say. And the planner was all stoked and excited about, look how great this is and stuff. Of course, it's obviously their job to sell. But relative to other relatively quote unquote secure investment opportunities in a very low interest rate environment, it probably is great. Just like I've got something on my table right now, on my desk right now from Discover saying earn over 5x more interest. But the thing is, it still means less than 1% return, just because the other interest rate options are so terrible. That's the only thing that makes that look theoretically good. And so when this entrepreneur heard this, and the planner was like so excited, said when they left the meeting, he was talking to his wife, and he was like, "That's terrible," because he's comparing it to what he knows he can do with his business. It's like, in my business, if I put 10 grand in my business in 10 years, if I don't make 10 or 100x that return, I've done terrible. And that is part of the mindset I want us to shift to as well, okay? Because most people think you and I are dumb, okay? Let's just admit that. Most people in the investing space, they think and want us to be dumb, okay? And the reality is we are very limited in our time. You know, most of us have other full-time jobs, and that is a very real constraint. And we want to take that seriously. And probably many of us are very limited in terms of our investing and financial background. One of the reasons I created Invest in the Family is to help meet that need and change that. I want to help empower all of us to become much more empowered and confident investors, and be able to manage things within a limited time frame. That's one of the objectives of this business and this podcast. And so I want us to have that mindset. I don't want us to fall in the category of, look, well, I've only got a little bit of time, so let's see what's available. And then we're prey to all these people who think, hey, let's go make money off dumb investors. Okay. I don't want to be a dumb investor, and I don't want you to be a dumb investor. That's not what we're about here. So, but that's the difference in my mind between a market index, where you're making in 50 years, you go from $100 to $12,800, or being a business owner, a smart, conservative business owner, and going in 50 years from $100 to $1.6 million. Which one of those do you want? That's what you've got to answer for yourself. I know my answer, and that's why I'm doing what I'm doing, and that's why I hope you come with me. Moving on. Another thing is that I never realized, obviously, I'm very aware of the fact that Berkshire Hathaway is like a big holding company, and they buy other companies, and there are plenty of companies that they own outright or have acquired. But in my mind, because I've never looked into Berkshire, their financial statements, I've always just thought, there's 12 or 13, 14 companies that they own or have acquired. Way off. And it's not listed the actual number of companies, and I'm not going to sit here and count them. But dozens and dozens, I'm going to ballpark 40 plus companies that Berkshire Hathaway owns or has acquired since 1965. And another thing that's so important to remember is that most of those came beginning in the mid 90s. So most of that has come in the last 20 years. So again, that's the idea of the compounding growth of things. Is in the early years, it seems like nothing is happening or very little is happening. But with that power of compounding over time, once you get a few decades into the business, as a business owner, as an investor, as a portfolio manager, however you want to view yourself, and I think all of those are things that we want to discuss and focus on. It's after a few decades that incredible growth starts happening. And the mistake that most of us fall into is we start thinking we're too short-sighted. We start thinking, man, my portfolio is small, or maybe it's not small, but it's not as big, and it's not as big as you want it to be, and growth is so slow. It's taking so long. And then we start shifting gears to try to find a faster growth option. And every time we do that, we undermine what's happening in the future. I want us to be investors that are about planting trees and growing trees. We used to have an amazing red oak tree in our front yard, and we moved into our house a few years ago, and it was such a beautiful tree that it's almost like we bought the tree and the house came with it type idea. And we were just beside ourselves a few years ago when a big storm came through, and basically we lost the tree in the storm, and it was really hard. On a relative perspective, obviously there's a lot much harder things in life, of course, but it was a real bummer for us. And we since planted a new tree that, we're excited about, but it's going to take a long, it take decades for this tree we just planted to become what the tree was before it. And there's very little we can do to speed that up. We need to nurture it. We need to care for it. The point of the illustration being is, in time, this tree out front, if it's cared for and survives, will become an amazing, big, beautiful red oak, like the one previous to it. But what if I took instead of just being patient and caring for that tree and being responsible for it, I said, man, it's been 2 years and the tree isn't as big as I want it to be or growing as fast as I want it to. I'm going to take it down and plant another tree instead. And that sounds ridiculous to every one of you listening, but that's basically what we're doing with our investing when we keep shifting gears all the time and aborting our plans. And so we need to stop doing that, because we need to realize the long-term power of having a business like a Berkshire Hathaway, which is again why one of the themes I want to carry with us through this process is building Berkshire. We're all building our own versions of Berkshire Hathaway. So, and now I'm going to jump over into some of the first letter, but actually I'm going to backtrack to the introduction to the book, because Max Olson is a man who compiled these shareholder letters and put them together in the book. So we're very appreciative to his work regarding that. In the introduction to this compilation of Warren Buffett's shareholder letters to the shareholders of Berkshire Hathaway, he quotes Warren Buffett, and I love what he says. He says, Buffett has said many times that he, quote, was wired at birth to allocate capital, end quote. And then Olson goes on to say, by allocating resources to assets and endeavors that have the greatest potential for gain, Buffett has guided Berkshire to creating enormous value, not only for shareholders, but for the managers, employees, and customers of its holdings. That idea right there is what I want. That's the mindset I want to have, and I want you to have. That we are allocators of capital. That sounds way more grand than DIY investor. I'm fine with that term because it's true and I have no problem with that. But the connotation a lot of us have with that is, well, okay, I've got an E-Trade account or a Fidelity account, and I'll buy a few shares of this company or that company, and I'll read a few articles here or there and stuff like that. And that's what we think of as investing. Okay, to me, that's hobby investing, and to me, that's danger investing. I don't want to have that mindset anymore. It's fine if we use those tools and resources. It's fine if you use E-Trade or Fidelity or Trade King or whatever else. That's fine. But I want to have the mindset that we are allocators of capital. Maybe we only have $10,000 of capital to allocate. Maybe you have $10 million of capital to allocate. But we should treat it with the same seriousness. We are business owners in that business. We're in the business of allocating capital, and we are building Berkshire Hathaway. And so we want to have the mindset that we want to allocate resources to assets and endeavors that have the greatest potential for gain. And that may mean holding cash because we haven't found an opportunity yet. And we're perfectly okay with that. I had a conversation with someone yesterday about they are having a big lump sum of money coming their way, and they're really eager to invest it. And I told them they need to do what they feel is best, but it's almost never a good idea to rush the investment of capital. It is in almost every scenario better to be patient and look for great opportunities to invest our capital. And so that's the mindset I want us to have here as well. And so that's an idea that I want to continue to reinforce for all of us throughout the series and throughout the business of investing in the family and this podcast. So let's go ahead and jump into the first letter. And I know you're thinking, oh my gosh, we're almost 30 minutes in. We're just not starting the first letter. Don't worry. The first letter is almost just like it's one page. This is the 1965 letter, and it's basically just talking about just kind of some financial updates and a few business updates regarding Berkshire Hathaway. And technically, it was written by Warren Buffett, but his name isn't even on the letter. It's signed by the chairman of the board, Malcolm Chase, and the president of the company, Kenneth Chase. So the main thing I want to say here is basically kind of walking through, and it kind of gives some glimpse into, okay, so Warren Buffett has taken over the company of Berkshire Hathaway. And those of you who may not know that, Berkshire Hathaway is actually a textile company that Warren Buffett purchased in 1965. So the reason his company is called Berkshire Hathaway is because he bought this textile company named Berkshire Hathaway. And over time, and we'll learn more about this as we read future letters, basically they're making so much money through that company, they realized that it made more sense to invest that money outside of Berkshire Hathaway in terms of the best opportunities for return. So again, he has the mindset of he's an allocator of capital, and he realizes it's best to allocate this new capital outside of Berkshire Hathaway, basically by buying other companies, public or private. And that's where the conglomerate of Berkshire Hathaway began, and they started acquiring other companies beyond the textile company that Berkshire Hathaway began as. And so really some things that I'd want to highlight in this first letter is, first of all, the mundaneness of it. It's not exciting. It's just here's some numbers, here's what's going on. And our companies, as we begin them, probably won't be very exciting either, and that's okay. We may have a one-page shareholder letter. You know what? I think it'd probably be actually a really great idea for us to write letters to our shareholders, even though we are the shareholder. It's just us. But it's a good discipline for us to have that kind of seriousness and mindset and evaluation and assessment of how things are going. And so one thing he talks about is they will complete the liquidation of unprofitable plants. So again, he's coming in, he has the idea of they want to focus on allocating capital on profitable endeavors. And they found plants inside of Berkshire Hathaway that were unprofitable, so they closed them. As investors, there may be things we need to stop. There may be investments we may need to let go of in this journey, and that's okay. But we need to focus on what are the best assets and endeavors we can allocate our capital to. And honestly, I'm going to leave it at that for today. I don't want to dig too deep into the numbers of Berkshire Hathaway right now, because I don't think that'd be super fruitful, and I want to be mindful of your time as well. But this is the introductory podcast for our Building Berkshire series. I am stoked about it, and I'm sorry my voice is kind of crummy for this opening one, but I think you can probably hear me well enough. And so thank you so much for listening. Thank you for being here. We're going to build out this idea much more than today, and we're going to have some different ways for us to engage together in this process, and I'm really stoked about, but we'll save some of that for upcoming weeks. But for now, thank you for listening. I hope you have a great week, and we'll talk to you soon.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.